Good afternoon. My name is Alvin Fan. I'm the CEO of OP Investment Management, Asia's #1 hedge fund platform. We have a very special guest today, a good friend of mine, Mr. Scott Davies, founder and CIO of CDAM, a boutique shop. And I say that in quotes because he's still running roughly 1.5 billion in assets, primarily in uniquely concentrated portfolio of global equities. We'll dive into the strategy in a second, but a bit more about Scott. Scott founded CDAM in April 2006 with former colleague Adam Chamberlain. Prior to establishing CDAM, Scott spent 4 years as senior portfolio manager for the proprietary investments at Manulife Financial. For this, he was a vice president of prop trading at TD Securities from 99 to 01. From 91 to 1999, Scott was in Toronto and London, fixed income capital markets at JP Morgan. Scott earned his professional designation, a CFA in 94, graduated from my father's alma mater, in fact, Trinity College at U of T, University of Toronto, with a Bachelor of Commerce and a specialist in finance and economics. Welcome, Scott.
Thank you for having me, Alvin. This is great. Good to see you again.
Good to see you too. Are you calling us from Toronto or are you calling us from UK where your manager is?
No, we are in London. So I moved back here in 2006 after spending a good part of the 90s in London. We moved back to Toronto in 98 for some family reasons. And then when Adam and I decided to open the business in 06, I moved back at the end of 05. So very happy to be back here in London. Kids are here. It's home now.
Excellent. That's great to hear. I mean, I love London. I plan to go back next year. A lot of my friends, however, after Brexit have left London. So, amazing to hear that the investment management community is still alive and well, I take it.
It is. And, Brexit hit many parts of the economy. The service sector was the biggest one impacted, but asset management still seems to be strong. London has this mantra that if asset management is strong, it'll maintain the banks and that'll maintain the financial center that it desires to be. So I think it's struggling to win IPOs, but it's still a very big center for asset management. And that's where it wants to go forward.
Yeah. We're calling from Hong Kong here. Sunny Hong Kong. And I think if you replace that last paragraph you said with Hong Kong, it would describe it relatively the same, ironically. Scott and I always seem to get on a call or conversation just in around after some major crisis or scandal. The last time was the regional banks collapse. Before that, I think was shortly after FTX. As of the time of this recording, war has broken out along Gaza Strip. Israel retaliating against a brutal attack by the Hamas in one of the most public displays of aggression. Never a dull moment, Scott. So let's start from here, since there's no better place to start. I know that your strategy is not necessarily a macro strategy, you're more of a fundamental base out. So two questions here. The first is, how is your team observing where global geopolitical dynamics are today, especially what happened over the last week? And a follow-up question to this is, it's tough running a fundamental shop bottom up. So, how are you guys still making it, a successful case?
Well, for us, macro has always been a big part of our process. I came up under the macro background with JP in the fixed income world and understanding how liquidity and central banks operate and tying in fiscal and monetary policy on how they affect the markets. And we've always believed in the capital structure. If you know where the overnight rate and you can build it out, then you can price pretty much any security out there. So it's very much part of our process. Now, we don't make macro bets, as you mentioned, but knowing the environment you're in is really important, and bracing yourself for opportunities, we would always see it. CDAM has always been a place that when things get chaotic and markets get discontinuous, we have enough experience and we have a process that we're able to take advantage of it rather than throw everything out the window and try to start from scratch. So you're right. Being a long-term fundamental investor, it is tough when you get a lot of these short-term movements, and you can try to take advantage of them. But we've never found that battening down the hatches once you hear about the event makes a lot of sense. And you and I have spoken a lot about that, how you manage your risk. And managing risk is trying to be as diligent as you can be to assess the situations that you're in. And most of that for our portfolio is just trying to assess monetary policy. If interest rates are going higher, assets are going to be discounted, and that's going to have a long-term effect. As much as we hate to say it, wars and all the casualties that go with it tend to have a much shorter term effect on the markets. Historically, that's always been true. And you can even see from the first few days after this, the markets are very aware of it, but there's no discounts built into the markets anymore.
I think there was a narrative on the last 24 hours of whether or not increasing aggression and the war in the area would impact oil logistics, as it is close to a major port that supplies oil. And it looks like the OPEC and some of the members are looking at or are setting up the market to prepare for higher prices, which we're kind of seeing a little bit. But generally in the equity side, not too much change. If anything, it reasserts the notion, I don't know, maybe you can tell me different, or if you agree, that rates are going to be higher for longer, stickier for longer. And this is going to continue to put a little bit of pressure on smaller businesses. But the question is for how long?
Well, I agree. I mean, whenever you're trying to look at a situation, we try to stay in our lane. It's easy to sort of say, I think I know what's going to go on politically, or I think geopolitically as well. But what we know is finance and economics, and we should stay there. And so what we look for in any scenario was, what is that going to do to the cost of capital? That's right back to the capital structure discussion. And is the war or the current outbreak raising the cost of capital? It's not. We haven't seen a move in interest rates. Is it affecting prices? As you said, there's no infrastructure impact yet. So we're not seeing any of that. And that's what we can go on, and we can be good at that. When we look at the current interest rate scenario, what overshadowed even the entire outbreak in Israel is the comments by Ferguson, the Fed governor, who said, being a little bit dovish, and this was followed up this morning by a non-voting member, Daly, who followed on with being dovish. And these are very coordinated. The Fed is very careful on how they want to communicate a message. And their message was that they are going to be higher for longer, but they're not going to be much higher. And so I think once you get certainty, and you and I have talked about the difference in markets when they're uncertain versus certain. And once you have certainty into the market, they can start pricing again. We talked a little while ago, when markets are discontinuous and volatile, you don't have the ability to pick stops. You're sort of running for safety, or you're running to some few instruments that whether it's bonds. But once everything settles down and you have a bit of an outlook on it, which I think the Fed is trying to provide right now, then you can start repricing all the different assets and taking advantage of something that's cheap versus something that's expensive. And the last couple of days has suggested, and the Fed is coming out trying to reaffirm, that we're going to be higher, but we're not much higher, and that we're not going to stay here forever. So that's the message. I think that's been good for markets. It's adding some stability to markets, which probably, in light of what's going on in the Middle East, makes some sense.
Yeah, I think this is a good time to segue into how you run your book. And I want to preface this by first highlighting, even for this conversation, you run a very concentrated book. It's a very long term, and there's a tilt towards small and mid cap. And you use a term called compounder. For those of us who are meeting you for the first time, maybe you can walk us through how you look at companies and how you take a more unique look at fundamental approach, because you do focus more on proficient allocators and acquirers in the market rather than just a vanilla approach to a fundamental bottom up. So why don't we start there, and then I'll throw some rocks.
Sure. Our journey has been really interesting. And as I say, but my background in the fixed income markets and into the equity markets, and then we're running a portfolio at Manulife that's just really concentrated. So concentration has been part of our DNA, and we like it. We think there's an edge to it. And academically, there's some research that says there's an edge to concentration. And we think that as portfolio managers, there's only so much capacity you can have in your head before you start losing track of who does what. So we like concentration from a number of levels, from a risk level, from a return level, and from also a mental resources level. So that works very well. And that's been part of what we do. How we pick and invest in companies is something that's been almost 16 years in the making now. And as we started, very much fundamental value investors looking for those things like spinoffs and reemergence from bankruptcies and special situations and rebalance sheet arbs. All of these things that people are familiar with, we did, and they were part of our playbooks, and we were doing well at them. But we did notice that there were some things that we were doing even better with. And when we started taking a look at our portfolio, and we actually had someone come in and tell us, hey, what are we doing right? What are we doing wrong? And they said, these investments that you keep making in these instruments you call compounders are your best investments. And so we started leaning into this. And so a compounder for us is a company that's able to reinvest its proceeds or its earnings at a very high rate and reinvest almost all of them. So although we have companies and people will think about compounding because it produces a steady return for a long period of time, the secret to all of that is that you have to be able to reinvest at a high rate, and you have to reinvest a lot of your earnings at a high rate. So if you look at the S&P, just as an example, the average amount of earnings that's reinvested is just below 50%. And if you look at the MSCI, that's probably closer to the world index, probably closer to 35%. In the companies we're investing in, they're reinvesting 80 and 90% of their earnings.
Wow.
So the simple math on that is that if you have a company that's able to earn 18% ROE and it's able to reinvest 50% of its earnings, and that is exactly what the S&P is, then you're going to have a company that grows around 8-9%. If you have a company that is able to produce a 20% ROE, which is what our book looks like, and they can reinvest 80 to 90%, then you're looking at a 16 to 18% return, which is what we're targeting. So we really focused on that, and we said, finding those type of CEOs that can find those industries where they can continue to reinvest their money at very high rates is where we want to be. And then we found that there's two specific types of CEOs. So you drill down even further. And as we move further and further down this, we're moving away from competition. So not many people are looking at the markets these ways. So we were looking at CEOs that can either roll up industry, so acquire all the companies within a certain industry, or roll out. And a retail rollout would be a good example of that. They're taking the proceeds and opening new stores. They open a steady amount of new stores every year. So that CEO who understands his role as a capital allocator, trying to find the best investments he can through acquisitions, or trying to find the best investments he can through store openings, was who we wanted. And when we did the research on this, and we went back decades and decades and decades for as long as the market's been open, this has been a proven strategy. But it's a difficult one because modeling acquisition is very difficult. And of course, there's a lot of literature out there that says that it destroys value. And we would completely agree. 80% of those deals do destroy value, but we focus on the 20% that don't. And that's where what people are missing. If you and I are buying companies in the public markets, we're probably paying a pretty good premium because public market companies are very well priced. But if we're buying companies in the private markets, they're not as well priced, and you can tend to get a lower multiple for them. And so we're interested in those CEOs that trade publicly but buy privately, or trade publicly and roll out privately.
Yeah, it sounds like you're actually really leaning in, as you say, in a space where, because there's a natural, at least from a capital markets and a technical perspective, a dilution of value, a lot of investors would start to shy away, especially as they approach these types of, liquidity events. Whereas you're kind of leaning into these events in a way. But I wouldn't go so far as to say that you're an event-driven manager. That doesn't sound like what you're doing. You're looking at a track record of roll-ups and roll-downs and seeing, hey, is there a track record of successful acquisition strategy and rolling down strategy, and then deploying capital? Or are you looking at events as a catalyst for your entry?
It's definitely the track record. What we found in all our research is that you can't invest in a CEO unless he has a long track record. And we really look at 10 years or more. Wow. So it's easy for a CEO to get lucky over the first few years, especially if they're acquiring. And we found that you can be lucky for almost 5 years. And that's happened many times where the CEO will speak a language of capital acquisition, will sort of talk like an investor, but he is more just trying to acquire market share, and he's not disciplined on price. But those that are very disciplined on price, that have set as their strategy, we're going to grow through acquisition. Those with a long track record that do that are extremely reliable. And that's what we're looking for. When you think of the world of CEOs, you have the caretaker CEO, let's say, which is about 50% of the index. And that CEO is there to run the business, reinvest some of the proceeds to make sure the product is being done as efficiently as possible. And they're kind of at the return on equity and reinvestment of the S&P. And so they're the average return that you'd get. And that's about 50% of them. You have these wonderful visionary new product type of CEOs that we all love to read about, and they can push a product and they're bringing out something new. And that is just this hyper growth that's wonderful. And everybody loves to get onto, but they're extremely difficult, as we know. You don't know when they're going to mature, when the product's going to break, or when the costs are going to add up. And of course, businesses like that attract a tremendous amount of competition. So what we're saying is that there are different types of CEOs doing different things. And we want the CEO who really is an investor, who thinks of, and this is back to our capital structure, that cost of capital. thinks about what is this going to cost and what can I earn on this? And most of the CEOs we deal with deal strictly in their acquisitions or their rollouts is using their own cash. So they've found that borrowing money or issuing stock is not the best way to achieve growth, but you're reinvesting a high amount of your own cash and stopping there is the best way. So they really are cash investors, and it's a unique group. And we think of all the companies out there, there's probably 6% of them.
Wow.
And yeah, so to tie that into your event comment, the best way to buy them is when an event happens because they can go on sale. And so although we prefer the track record, event really gives you that entry point.
So it feels to me that your job as a CIO is not that dissimilar in a way to how fund of funds work. And most managers can make money in a good day. The tougher job is finding managers who can make money through a cycle. And it sounds like the metrics you're using are very similar to how some of our fund of fund allocators are looking at managers in a way. So the second takeaway that I get from this is you pointed out it's very, very hard to have a track record of 10 years or longer of successful, because in this space, as you say, there's mispricing, constant mispricing in the private markets. It's extremely illiquid. And more importantly, and I think we'll touch on this a bit later, is the integration costs and the difficulty of integration is incredibly difficult to model. So how's your team able to get, and I assume it has a relatively high hit rate on finding these CEOs. How's your team look at it slightly different from others? Is it simply a matter of observing the fiscal discipline on leverage and CapEx, or is there something more that you guys look at?
Well, our process, and it really has continued to grow, and the model we use for finding, and the way we approach it is we are looking at the markets and reviewing the markets and scanning the companies once a week. And we're taking the entire universe and putting it into our model and saying, does anything out there fit what we're looking for? And we built this model that we believe is the correct criteria for really smart filtering down the companies that we want and don't want. And then from there, then we do the testing, as you say, and that's a very rigorous process that we do to try to find them. We tend to focus on companies that are decentralized. And that's a whole new aspect that we found in our research process.
Well, what does that mean, decentralized?
Well, you mentioned integration, and trying to integrate an acquisition is extremely difficult. And when you look at the failure rates, when you acquire and integrate, they're very, very high. But when you acquire and just leave it standing there, so I buy your business and I say to you, here's your liquidity event, Alvin, and you can keep your name on the door and all your stuff. We don't want to touch anything because you built this amazing business. We just want your cash flows and we want to help you in a way we can, but we've given you your event. So remaining decentralized and acquiring in a decentralized base. And so you think of it, your head office is a handful of people that are allocating the capital, but you may have hundreds, in some cases, thousands of companies around you that are operating under your umbrella, but they maintain their same name and they're operating their businesses. And those businesses actually go to work for you. So it's an amazing, unique model that most people haven't delved into.